Welcome, everyone. This is Justin Muscolino, CEO of Tweezle, back for another episode of PB&J, Pam, Bob, and Justin. Now, today, this is a little bit more front and center. We're going to talk a little bit about the release of the OCC Risk Perspective Report. Now, the report got issued a couple of days ago on May 18th, and it does detail a lot of different risks that are pertinent in the environment right now, and also some emerging ones. So for those of you who don't know, a committee part of OCC, the National Risk Committee, NRC, publishes this report on a semi-annual basis. And it covers 5 different areas: the operating environment, bank performance, and the third one is more pertinent for this discussion: specific topics in emerging risk, key trends, and also any supervisory actions. So again, I want to welcome Bob and Pam to the show today. How are you guys doing?
You can see here I'm joining from a short vacation. So this is not one of those Zoom backdrops. It's a real beautiful, lovely spot where I am. So I might be a little more easygoing today than in previous weeks.
Thank you, Pam. Bob, are you going to be easygoing today?
Well, yeah, I have to be. It's been raining here for a week, so I'm sitting here in my dungeon and can't go outdoors.
Very cool. All right. Well, great to have you guys again for this week episode. So I guess the first question is, before we go on to the different risks that were identified, does anything really stand out in this report that differentiates it from prior reports? Things that jumped out to you that like, that's interesting, or that's new, or, I'm glad they're addressing this issue.
For me, I think I always get a little frustrated only because the regulators are always looking backward at what has happened and then just sort of telling us what happened. So I think that even with the emerging risks that are depicted in here, when we talk about cyber, when we talk about margin compression, when we talk about the forecast economically, I think that there's too little discussion of how these risks might be mitigated. It really is just an observational piece, and that leaves a lot of us who have been bankers or who work with bankers really a little frustrated at the lack of guidance on what can we do to ward them off.
Yeah, let me kind of go down my punch list here. So I am very concerned about cybercrime. The recent events with Colonial highlight the fact that our networks are vulnerable. The banks have stressed their systems to the max to allow people to work from home for the last 18 months. And I don't think that anybody's really done a thorough job in testing all their different vulnerabilities across the entire network, including those people that are in a work from home environment, to make sure that they don't have any vulnerabilities themselves. I'm very concerned about the level of deposits today. Deposits are extremely high, historically high levels. And that's artificial because the government's been providing so much stimulus, and the consumers in particular have been saving about 2/3 of that money from the stimulus in their checking and savings accounts. Sooner or later, those consumers are going to start spending that money. And when they do start spending that money, we're going to find that there's going to be a demand for deposits as people try to prop up their loan to deposit ratios. And the cost of funds is likely to be going up in a rising interest rate environment with increased inflation. I'm also concerned about the lack of thoroughness on the part of the examiners, and they told everybody they would back off a little bit on the diligence that they were going through during this recession, but they're really going to need to step that back up again and really identifying where our real problems are within the industry. They hint at that within this report, that perhaps we need more diligence and we may see some surprise in terms of asset quality going forward. Justin, back to you.
So what we're going to do is go through the 4 key risks that were identified in the semi-annual report. And, we're looking at compliance, credit, operational, and strategic. So let's start off the conversation on credit. Now, Bob, I got to throw this question out to you. Now, according to the report, it doesn't look like the consumer ends of the loans are a problem right now. It's more on the real estate on commercial, which was really being pointed out. And obviously, because the remote working that's going on now and probably will for the future, a lot of these places where businesses were located might not be fulfilled. I'm sorry, might not be filled with other occupants. And I wanted to get your thoughts on it.
Yeah, I'm a little concerned about the loan portfolios and credit risk at the present time.
Mhm.
They skirted by many of the issues. The CFPB issued something we discussed a couple weeks ago about pending foreclosures coming up, and there are millions of pending foreclosures on the horizon right now. And during the testimony before the House Financial Services Committee this week, the credit union industry admitted they have over 1 million foreclosures they're looking at also. So there's probably at least 3 to 4 million foreclosures on the horizon as compared to our average about 900,000 foreclosures annually. Now, on the credit risk side, they discussed agriculture, and they said agriculture is probably strong, but because of the very deep subsidies that they've gotten from the prior administration, but those are not likely to continue during the current administration. So that now is subject to what type of weather conditions we have during the upcoming year. In addition, commercial real estate is still weak. They admitted that, in particular the hotel, motel businesses, convenience stores, and restaurants. And it'll depend in some cases on how fast they can get new employees to come back to work in these institutions if they can continue to operate. I saw a report on the news yesterday where a hotel in one of the local cities was likely to have to close because they could not hire employees.
Mm.
In addition, we've got this whole problem with the consumers. They have been paying down credit. We expect them to go into a buying surge sometime later this year. The biggest problem in housing right now is that the prices are grossly inflated, and that bubble may or may not burst sometime in the near future. And so that could cause some problems with regard to appraisals. Back to you, Justin.
Yeah, and just to follow up to that, it just feels like history is going to repeat itself with the last real estate issues that we experienced. It just seems like a similar pattern. I'm hoping for the best, but with inflated prices, there's just, it's very reminiscent of the last one. So let's change subjects. Let's get away from the credit risk aspect and focus a little bit more on the compliance risk. And we're going to bring Pam into the conversation on this one. So Pam, the way I look at it and what's indicated in the report, volume is increasing in financial institutions, transactions. I mean, because of the CARES Act, PPP, and all of that. That's, to me, just screams a sense of a risk, compliance risk within that financial institution, because of resources and just volume could create so many issues. What are your thoughts?
I think you're right about that, Justin. I think the other issue with compliance is, and this really goes to the point of how all these risks are interwoven. So as margins compress, institutions are going to look for different ways to drive income, right? And they're going to look to new products and services that they may or may not have a lot of experience with or exposure to. They're trying to compete on so many different levels with different kinds of lenders and deposit providers, whether or not they call themselves banks. They behave that way, and it's kind of transparent to the consumer, or should I say inconsequential to the consumer, what it's called. It's just how these things operate that matter. And so I think that urgency that's going to be created to go into new lines of business is also going to tax a lot of the compliance management systems that people have in place. They have not necessarily been equipped in traditional banks to move quickly with change management. They have not always done a good job. And my friends in the regulatory community tell me stories almost daily of how the revenue side of the business wants to do something new, but they don't include the risk and compliance folks in the conversation until much further down the line when some of these decisions have already been made. And so I think there's going to be an intense pressure on risk and compliance teams to become more agile, to become more innovative, in really responding to a different kind of threatscape. Also under that umbrella of compliance, I would put things like third and fourth party risk, where you may be dealing, especially on the community banking side, people are dealing with hundreds, literally hundreds of third and fourth party vendors. And their due diligence techniques are not necessarily sophisticated enough to keep up with the threatscape that is faced by those vendors. So I think we're going to see, in addition to the escalating volumes that you mentioned, that are going to cause a lot of BSA AML risk, for example, we've already seen dramatic instances of fraud in all of these federally funded programs. That the aftershocks of that are going to continue in the coming year. So I think there were a lot of those more operational elements, and I know Bob is going to touch on ops risk as well. But I think those often get overlooked when the regulators are tackling some of these compliance related issues. It's not just, do we know what to do? It's, are we doing it consistently across our enterprise? And I think that that really challenges some organizations.
So, Bob, I got a question for you. And Pam had a good segue with the operational risk side. The beginning of the conversation, you were talking a little bit about the cybersecurity threats, right? So, I mean, I would love to hear more. What do you think as far as the type of risks that are pertinent right now in this environment when it comes to cybersecurity?
I think the complexity of our environments is increasing on a daily basis. And in many cases, the financial institutions are running core systems that in some cases, their basis is 30 and 40 years old technologies. And they're just not equipped to deal with modern day criminals. Somebody posted a post on LinkedIn the other day and said, what would you advise a core system provider, CEO, as to what they should do going forward? And I said, stop developing your old systems and start investing in new systems. It's time for a whole new platform. Many of the people in bank management roles have not been properly prepared to deal with technology changes. Most of them come up through the lending side. They're individual performers, and they don't really get a good exposure to technology until they're in a very senior position and they haven't learned the basics of how to run a frontline technology operation. In addition, we've got the customers and employees now working from home or working remotely, whether it be bank from home or processing loan requests from their apartment. And we really don't know what the technology challenges are there. And how do you control an operational environment that extends into somebody's home environment also, where you've got children and relatives and other people coming into that environment in an unsecured world. So I think cybersecurity is going to get tougher and tougher. We've got criminals now, they're backed by political entities. I mean, there's a strong connection between these guys that hacked Colonial and the Russian government. Mm-hmm. And the Chinese have been accused of this, and the Koreans have been accused of this, and the Iranians have been accused of this. So it's a much more complex environment than it was a few years ago.
It is a much more complex, especially with the cybersecurity threats coming from a global scale. And we have to be prepared and have that right infrastructure. So hopefully we'll be more proactive in the future to help with those encounters. So another risk. There is another one, Pam. Now I'm going to start with you on strategic risk. And, this is really big. So with banks management, the net interest margin and also trying to enhance earnings, there's a lot of risks that, could include cutting costs, staff, investments, or extending duration on loans. Do you think this is going to have a bigger risk that's detrimental to a bank?
I think a couple of things are true. I think that we do have some leadership teams, because of the push to modernize. We have some leadership teams that haven't really been through a significant downturn yet. We are seeing younger and less seasoned management teams approach these problems. Now, they approach them in a different way, right? They do have maybe greater speed of decision making. They may be more aware of the context globally in which they're operating. But they are not exactly sure of what are the proven techniques to weather some of these crises points. So I think that that will come into play for some institutions. On the opposite end of that, we have some very veteran leadership teams who are underplaying some of the more strategic risks. They're maybe failing to consider the totality of competition that's out there in the marketplace, or they're continuing to rely on marketplace strategies that do not consider competitive effects of things like non-bank lenders, and other competitors entering the space. There's, for example, there's a whole global discipline around retail financing where very large fintechs are coming in to help people finance sneakers and tablecloths. And it won't be very long before that customer base also matures in a particular way to enable them to go a more traditional banking route. So I think that there's a little bit of complacency perhaps on the parts of some institutions to really understand ways to mitigate their strategic risk. There certainly are the traditional techniques, go out and find new things to do, but those take time to spin up. They require certain amounts of expertise. And as Bob has said on repeated issues of PB&J, that there just is not a ready marketplace out there of labor that can be plugged in to solve these problems. So I think we're going to hear some familiar refrains like there's too much regulation for us to keep up with. We're going to hear familiar refrains such as there's nothing we can do about what's happening in our local community. It's just the way that it is. And so I do think that when it comes to figuring out how is our financial institution going to continue to sustain or improve earnings in an economic environment that's wildly different, I think there are some that are going to have to hone their skills. I do want to underscore one other point that's worth mentioning. The OCC in its report, they kind of stayed away from these issues of climate and the unpredictable effects of that. I think that, I just was reading this morning about the drought in the West being the worst that it's ever been, with more than 60% of California under severe drought conditions. Well, that's where a lot of our food still comes from, in those central valleys. There's that drought is also affecting farmers in the Great Plains, not to the same extent. But I think that we're really starting to see dramatic shifts. It doesn't matter what your views are on what is the cause of this change, but the data is there to say we've got to be thinking about things that we've never thought about before. Food shortages, water shortages, crisis points in these other types of areas that traditionally bankers have had to deal with that on a localized basis. And they were very comfortable in how those patterns shifted locally. But that global threatscape is really coming into play across multiple dimensions. And I don't know if everybody's equipped for it.
Well said. And with the drought that's going on, I mean, it could also prompt other catastrophes as well. I mean, what happened to California last year with the wildfires? So that is something that could pose a big risk, even bigger risk to everybody. So very well said. You two, it's been great having you on. We covered a lot of ground in a short period of time. Do you have any closing statements to make before we conclude this episode of PB&J?
Justin, I've got one. One of the concerns that bank leadership has going forward right now, that we're starting to see echoes of 2008 in the compliance environment of the regulators. In 2008, the regulators grossly overreacted as far as issuing formal agreements. We've not seen that yet, but there's a lot of talk that they're going to start managing through enforcement orders instead of through regulations and the law, because they can't get anything through Congress. And when you've got situations like Operation Choke Point during the last cycle, and that was discussed this week in front of the Financial Services Committee, we need to make sure that the regulators don't cross over the line and start enforcing things that really are not within the spirit of what Congress is attempting to get us to do. and really is some special interest groups' concerns. Back to you.
Thank you very much for coming on, and I want to thank everybody for attending. So for more great content and subject matter experts, visit us at tweezle.com. Take care, everybody. And I love the background, the birds chirping in the back. It's reminiscent of a fairy tale type story.
Except that there's compliance involved, so that's not very serene at all.
Taken, no taken.